Recessions are long periods of less economic activity, and they often come with lower retail sales, less industrial output, lower wages, and more people out of work. A country is said to be in a recession if its GDP has gone down for 2 consecutive quarters. A recession can have big effects on our incomes and jobs. Investors are in for a rough ride. But if you look at things from a long-term point of view, the stock market is still the best way to make money, even during a recession. Here are 10 rules for investing during recession. However, before we begin our countdown, we would greatly appreciate it if you would subscribe to our YouTube channel and also press the bell icon. Let's get started. Number 1. Remain composed. It is in your best interest to refrain from making rash choices, such as selling investments, when market conditions are volatile. Depending on the amount that you spent for them, you could wind up selling them at a loss and missing out on a potential increase in value. The plan is to keep one's attention on long-term goals while waiting it out through the inevitable fluctuations in market conditions, mainly due to the fact that the crisis in the cost of living and uncertainties will continue to promote market volatility. Number 2. Spread out the risk and diversify any investment strategy that needs to be diversified. Make investments in a wide range of stocks and bonds. Spread your assets across international markets as well to prevent becoming overexposed to downturns in any one location, and check to see whether your risk profile is one that you are comfortable with. Spreading your investments across worldwide markets also protects you from becoming overexposed to downturns in any one region. This is the amount of a drop in the value of an investment that you are willing to tolerate in order to get higher returns. Number 3. Maintain affordable prices. Fees for managing your money are charged. There are fees associated with exchanging money and shares, as well as fees associated with holding on to money, which is standard practice across all investment platforms. Check the expenditures associated with your investments to ensure that you are not spending an excessive amount of money, because the costs of different platforms can vary widely. Moving your fund to one that offers better value and lower fees will result in a rise in the fund's value. Number 4. Invest small amounts of money gradually. Particularly difficult is market timing, which refers to the process of trying to buy or sell stocks at exactly the right moment in the hopes of profiting from price gains or drops. When the market is volatile and marked by investor panic, it makes things a great deal more difficult. Instead, you should get into the habit of saving money on a regular basis and keep adding to it. By acting in this manner, you will ensure the success of your employment of the pound cost averaging method. If you do this, the price will end up being about the same overall because you purchased more units while the price was low and fewer units when the price was high. Number 5. Make sensible investment decisions. When putting your money straight into the stock market, find businesses that have a solid financial stand and business plans that can actually be implemented. Find companies that provide products or provide services with demand that is mostly unaffected by the health of the economy, such as sellers of everyday essentials, and investigate the possibility of investing in these companies. Like supermarkets, depending on the investment situation, you also have the option of putting your money into industries that are expected to do well. Number 6. Use discounted stocks to your advantage. Despite the gloomy projections for the economy, it's possible that investment stock prices will remain low. As a direct consequence of this, there is a potential for advantageous opportunities to acquire stock at reduced prices. Certain types of fund managers make it their mission to seek out undervalued companies that have promising potential for the future. These include legitimate firms and industries that have been impacted by the lockdown but are nonetheless able to survive despite the situation. Number 7. Have tolerance. Making money off of shares is currently more difficult than it used to be due to the fact that dividends are taking longer to arrive. However, investors are still in the game, even in situations in which corporations have reduced their dividend payments or stopped paying them altogether. There is a good chance that the payments will begin. Once more, in the future, one of the best ways to identify dividend stocks that offer a high yield is to look for businesses that have a large amount of cash on hand and no debt. Number 8. Seek safety nets. It's possible that a lot of investors are mulling over the idea of putting more of their money into corporate bonds as a hedge against the volatile equities markets. Investors are entitled to interest payments in exchange for the money that they lend to firms. The reasoning behind this in other areas is that gold's performance is unrelated to that of stock markets. It is a trustworthy store of wealth in challenging times, and when combined with bonds and precious metals, it can diversify a portfolio and ensure that your assets are not only dependent on the performance of the FTSE 100 or the SP 500. Number 9. Make a purchase from a pre-made portfolio. A large number of fund supermarkets offer ready-made portfolios that attempt to include a diverse range of investments, including non-stock market assets such as bonds and real estate. These portfolios can be purchased immediately. Your level of comfort with risk will decide how many are labeled, because there is no one definition that is universally acknowledged of what defines a balanced or conservative portfolio. You need to be sure that the risk category you have picked is one that you are comfortable with. An additional choice is to hire a professional fund manager who oversees a multi-asset fund that provides one-stop shopping as well as diversification. Number 10. Discover solace in the past. The economy will eventually recover from its current slump at some point. If you have a minimum investing horizon of 5 years, you should be able to benefit from the rebound of the market. Since 1899, the Barclays Equity Gilt Study has shown that shares have beaten cash deposits in over 76% of all 5-year time periods. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching and see you next time.